Hi, Jason Moser, analyst with Motley Fool One. Thanks for joining us for another edition of Ask a Fool. Today we're taking a question from El Ramirez, who asks, what are a few ways to value a company? Can a balance sheet tell an investor everything he or she needs to know before investing? Valuation is a very interesting subject, and there's no one pat answer. And a number of different ways to value companies. For example, look at insurance companies. We often see them valued based on the book value of the company. This is the total common equity, which incidentally is something you can definitely find on the balance sheet, divided by the shares outstanding. So you compare the price per share to the book value per share to get an idea of how the valuation compares to others in its industry. I'll give you an example here in Markel. Markel, for example, trades at around 1.2 times book value today. And if we look at another comparable in that segment there, another insurance company, Allegheny Corporation, trades for just a bit under a one-time book value. So does this mean that Allegheny is a better deal? Possibly. It doesn't mean for sure, though, and valuation alone doesn't tell you everything. You need to understand management, how the company makes its money, the company's competitive advantages, risks, future plans, so that all comes into play as well. Companies that generate more consistent, reliable cash flows can be valued with a discounted cash flow model. It's a great tool to have and to know how to use, but I find it to be more valuable really in understanding the inputs that go into the model and discovering how those inputs may drive a company's valuation. Things like margins and growth estimates, for example. But Coca-Cola or even Procter & Gamble, I think, would make excellent candidates for a discounted cash flow model practice. And two other common multiples that we see used to value companies are the PE ratio, the price to earnings, and the EV to EBITDA ratio, or the enterprise value to EBITDA. And the EV to EBITDA is a little bit different in that it's capital structure neutral, and what that means is you can more fairly compare companies with different levels of debt. Many companies out there use debt to their advantage, so it's always worth knowing how they use it. Typically, with any of these multiples, lower means a stock could be undervalued, higher multiple means it could be overvalued. But you look at these multiples over time to get a better idea of how the stocks are valued in their market for longer periods of time. And make sure to use them in common industries. The PE for a bank, for example, is going to have a different meaning than a PE for a company in a retail operation. And also remember that the market will tend to assign higher multiples to companies that are expected to grow more. So for example, it's why you'll see Under Armour with a PE of 60 versus Nike with a PE of 27. Nike's a bigger company, it's more mature in its industry, and it's not expected to grow as much at this stage of its development. Under Armour, still relatively new, could be a faster grower. But the bottom line is that valuation, while very important, it always matters, it's not everything. It's only one piece of the puzzle, so remember that. Companies, cheap companies are typically cheap for a reason, and that's because the market doesn't expect a whole lot from them. In a lot of cases, the market tends to be right. But certainly for valuation, you can go to Fool.com and type in valuation up in the search bar there. It'll bring up a plethora of information for you to check out. So great question. Thanks for asking, and make sure to check out Fool.com.